Hello, I'm Steve Balch, the Director of Wealth Management and Financial Planning at Certa Financial Planning, here to give you a monthly update for March. From a macro stance, not much has changed from last month. Despite the negative returns in the stock market in February, the market trend remains positive for now. Headwinds do persist, but seasonality seems to be playing out. And as the time of this video, we've only seen a little over a 6% pullback in the S&P 500 from the February 19th highs. The Fed policy was downgraded last month due to the rate cuts being on hold and remains neutral for now. The February minutes released by the Fed indicates that rates will continue to hold for the foreseeable future. The market believes the next Fed cut could come in June. Fiscal policy remains positive as it appears to be the main driver behind economic growth. This tailwind does not seem sustainable, though, as the federal deficit is estimated to be 6.3% of GDP for 2025. Leading economic indicators remain neutral for now. GDP numbers for Q1 are starting to revise downwards, and January's non-farm payroll report came in disappointing. On the bright side, though, December and November payroll figures were revised upwards. In addition, the unemployment rate dropped to 4%, and hourly wages did increase. Lastly, Core PCE, the Fed's favorite measure, was the lowest reading in 7 months, a sign that inflation may be getting a little bit better. Lastly, valuations remain neutral as the mixed bag continues. U.S. market valuations continue to hover around all-time highs and have caused a choppy start to the year. On the contrary, international markets with more attractive valuations have seen a strong start to the year. Time will tell if this rotation is short-lived or a start of a longer-term change. We've seen many head fakes on the international versus U.S. rotation over the last 5 years. The market regime has been downgraded to a mixed reading, providing us with a neutral stance for risk. Inflation continues to be an issue, but we are getting mixed signals about economic growth, leading to a mixed regime. The business cycle continues to be mixed between mid and late cycles. Recession risks continue to be muted as wage growth remains strong, but policy mistakes with tariffs and the Fed's rate management continue to be the biggest headwinds going forward. 3 questions we're monitoring for this month and going forward. Should there be worry about a negative February? Are there concerns over economic growth? Will spring bring greener days? Should we be worried about a negative February? After a resilient January, February saw negative returns across the broad U.S. markets. However, the choppy start to 2025 is pretty normal, especially after the 2024 we had. Historically speaking, after a 20% gain, weakness early in the year is perfectly normal. Additionally, as discussed in last month's update, volatility in the first quarter of a post-election year is common. And then finally, the past 20 years, we have seen a bottom in March. Time will tell if history plays out, but so far this year, everything has followed the historical script. Are there concerns over economic growth? As of March 3rd, 2025, the Federal Reserve Bank of Atlanta's GDP Now forecast estimated a contraction in real GDP growth at a seasonal adjusted annual rate of negative 2.8% for the first quarter of 2025. This rightly has caused headlines and concerns, especially after the tool projected a 2.3% growth rate just a week or so ago. In contrast, other models like the one from Goldman Sachs have seen a positive 1.6% rate of return in Q1. Nevertheless, all these models are showing slowing growth compared to earlier projections. We need to monitor this trend as it could cause an issue down the road. Lastly, will spring bring greener days? As we look ahead to the month, we want to remind you that March is historically a solid month overall, but the greener days for the bulls usually do not show up until the second half of the month. Let's hope that spring brings a change of weather and a change of market direction. Our positioning and outlook. As previously mentioned, the first quarter of the year after an election tends to be volatile, especially after Valentine's Day. So far in 2025, this seasonal move has played out for the first 2 months. If the trend continues, we could see a bottom happen sometime in the coming weeks. March, April, May also tend to be solid months in post-election years. The week February played out. Is it time for better times ahead? We hope so. Headwinds do persist, though, as inflation continues to be sticky and slowing GDP causes concerns. For now, we remain cautiously optimistic that the typical post-election cycle year plays out. As always, we'll continue to monitor and adjust as needed. We thank you for watching, and please feel free to forward this to anyone you believe that can benefit.